Joining us for a look at what to expect from the local market today, Evan Lucas from IG in Melbourne. Evan, great to see you there. Yeah, just firstly, talking about that Aussie dollar there and that US economic data seemed to be a lot more optimistic overnight.
Yeah, at the moment there's a little bit of sort of blurring between the data across what we've seen over the last 2 days particularly. Everybody is talking now about when the Fed is moving, and we'll talk about that in a minute. But having a look at the data that came out last night, was basically moving away from what we saw on Tuesday, which is all about housing data, and that was quite solid indeed. We did see the Case-Shiller index up at basically 7.5-year highs. We also saw their building permits at 5.5-year highs. So very, very good moves, very, very solid. Last night we moved sort of more towards the manufacturing and business environment with the core durable goods. Now, core durable goods actually contracted by 0.1%. Expectations had expected to see that up around about 0.5 compared to last month as well. It was up around about 0.3. So that was a little bit disappointing, and there is suggestions that Q4 over in the US is going to be a little bit more sort of subdued than expectations were there. And you can actually see that more on the public sector side, and particularly public sector spending. Something like defence contractor Lockheed Martin, they're actually currently trimming staff and closing factories. They went back last night, and that all gets down to that sort of business environment and business confidence when we saw the government shut down. But then on the other side, we actually saw good consumer sentiment numbers coming out of the University of Michigan. It was at 75.2. That is actually a 5-month high, and that was good to see. And that sort of contradicted what we saw the night before when we actually saw the the consumer confidence numbers contracting for the month. So there's a little bit of blurring of the data at the moment coming out of the US. It's why you can see when you look at the US trading session, yes, we were heading into Thanksgiving tonight, and it's therefore always a low trading day. But the last 3 trading days have been very, very varied, and they have moved around quite violently over the actual intraday move. So yes, we got a positive move. It looks like we'll get a positive move here in Australia, but all of that meant that at the moment you can look at the Aussie dollar, you can also look at the euro and find out which side of the ledger that people are actually believing and investors are believing it's moving towards. And the fact that the Aussie dollar again slid overnight, we're now below the 91-cent handle, suggests that the good data is actually what people are concentrating on, and therefore leading into the Fed meeting on December 17th, and then obviously in January as well, that they are getting a little bit more excited that things are getting a little bit rosier and that tapering is probably coming, and that's why you're seeing the US dollar actually strengthening against most of its major pairs.
The outlook for our market then today, you mentioned you think we'll see some modest gains at the open?
Yeah, it's probably about time actually, Bridie. We've been sort of disconnected to what we've seen out of the US. We've been following what happened more likely in Europe. You alluded to in your opening the fact that we have seen particularly the industrial metals, so things like copper, aluminium, also zinc, sort of sliding, and have been sliding quite strongly over the last couple of days. And we have followed that. Yesterday was a prime example. We saw the banks doing quite well, but the entire sort of material space really sliding away, and that might reverse today. BHP's ADR does look like it's pointing up probably around about 0.3, 0.4%, which would be a little bit more solid ground. And it looks like the overall ASX will probably pop up around about 20 points to 53, 51. So that would be a bit of a snap out of what we're going. We've got 2 more days to go in the month of November for trading. It does, unless we sort of somehow manage to have a miraculous turnaround, look like it'll be the first negative month in 4 months. And that's probably not a bad thing. We have had such a really solid sort of turnaround over that 4-month period. So we are expecting a bit of green on screen. It will probably mean that we'll have roughly around about sort of a 1.2, 1.3% contraction for the month heading into tomorrow's late trade. And obviously with it is sort of what we're seeing in the US with the holiday over there will probably mean that we'll have also light trade tomorrow, so unlikely to reverse that. But all in all, should be a fairly green on screen day today, Bridie.
Just as well, I know that you're focusing closely on the possible limits that we could see to interbank lending in China. What are you hearing, and what could that mean for our market?
Yeah, I think it's the first signs of the 60-point plan that came out 2 weeks ago actually starting to hit the book. So yesterday we saw the interbank lending regulations change. It basically means from now on that the Chinese banks particularly will have to have basically a safeguard to how they lend out. So if they want to actually move assets off their book, they actually have to write that into their books themselves. And what that means is basically instead of being able to write it off and making a loss and therefore putting it on an off-balance sheet situation, the Chinese government is now putting in regulations. It hasn't been voted on yet, but it looks like it will go through, considering they are a signal party government, that where the bank itself will actually have a vested interest in those assets remaining online and on their balance sheet. That is a regulation step in the right direction. It is all about liberalising how they do that, more sort of transparent in terms of how they do their budgeting, how they do their balance sheet regulations, etc. So it's probably the first step forward in that, and that's probably why we saw yesterday a little bit of a spike up in the Shanghai numbers. We also saw a little bit of a movement in the repo rate as well over in China, and all of this will probably get a little bit more advanced as they start to outlay how they are going to regulate the finance system over in China. It is a good step forward, but it will probably create a little bit of volatility in the short term. It also means that they are probably stepping closer and closer towards a less pegged sort of Chinese yuan environment, and that was also something that's been coming out very clearly from their central, for the People's Bank of China, over the last couple of hours and over the last day or so, that they are starting to move towards a more liberalised Chinese yuan, and that is also a very interesting step forward. It would be probably the biggest change in terms of Chinese economic policy in the last 50 years if they do start to move towards that direction. So that's also something we're watching very closely, and that's why you can see the regulation picking up, because they do need to get that in order before they actually start to move towards a floating currency.
Evan, as always, thank you so much, and we'll chat to you through this session.
Thanks, Bridie.